Hey guys, so I don't know if a lot of you know this, but I go to college and I don't actually study math. I study business. And that may come as a surprise to a lot of you, but it's just something I'm interested in and I don't know, I like it. So the problem is there aren't a lot of math-based concepts in my studies, and I don't have a lot of opportunities to kind of be like, ooh, whoa, that's cool. Let me think about that a little more. Um, there are a couple, and when they do arise, it's always a very fun moment for me. Here's one of them: the accounting equation. So I don't know if a lot of math people know about this, but in accounting, there's a fundamental equation. Basically, you can think of it as like the fundamental theorem of accounting or something like that. I don't know. Maybe I'll get some business students watching this. So hopefully, this will help you. The purpose of this video is to actually not explain it like everybody else does, kind of in that like this is exactly what it means sort of way, but instead in kind of a more mathematical way of how you can probably understand how debits and credits relate to each other. So if you don't know what any of that is, maybe just look it up a little bit and hopefully that'll help you understand. But I'll try to explain a little bit as I go. So what is the accounting equation? So let me get this red marker here because it's important here. So the accounting equation essentially states that assets, so it's anything that you own, are equal to liabilities. So that's anything that you owe, so anything that you have to pay to somebody else, plus equity, which is kind of just, you can think of it as just the rest. So assets, so I'll put this in black here. So this is own, and this is what you owe. And then equity is the rest. That's just the easiest way to think about it. So assets equals liabilities and equity. If you think about it this way, we can also rearrange this equation in a few different ways if we want to solve for something in particular, but I'm going to hold off on that for now. Whenever we're talking about actually doing some bookkeeping or accounting, record keeping, anything like that, we use at the most basic level, like accountants don't actually use this, but it's kind of an oversimplified way of working with different accounts. You would make these little T accounts. So here, I'll put an asset account here. I'll put a liability account here. And then I'll hold off on equity for now because that's a little bit of a mixed bag. So assets and liabilities, you can use T accounts for both. On the left, we have what's called debits, and on the right, we have credits. That's going to be the same for everybody. So debit here, credit here. Anytime you have, on the left side, it's always a debit, and on the right side, it's always a credit. Now, the thing is the thing that changes between assets and liabilities, as well as equity, but we'll talk about that later, is whether something increases an account or not. If you are looking at assets, debits increase accounts and credits decrease accounts. So if I say that so let me give you an example of an asset, cash, any cash that your business has, or even that you have. You can think of yourself as doing, accounting. Anytime you're budgeting, that can function as a form of accounting. So let's say you have cash. That's an asset because that's something that you own. You own that cash. And you would say, let's say you have $5,000 of cash. That's a debit. You have a debit balance of $5,000 in that cash account. Whereas with liabilities, it's the other way around. Credits increase them and debits decrease them. So let's say, let's say you owe something. Let's say you owe $100 to somebody for, whatever. It doesn't matter. So let's say you owe $100. That goes in what's called the accounts payable, because it's payable. You have to pay it. That accounts payable. And so you would say that you have a credit balance of $100 in that account. Okay, so credits, so it's like you want like debits for assets and credits for liabilities, even though liabilities are kind of bad because you don't want that many liabilities, but credits increase liabilities. So it's the other way around. equity also is kind of this way. Not always. I'll go into that in a second. So again, we have minus and plus, we have a debit and a credit. So again, credits are always on the right, debits are always on the left, but here we have, these two are the same. The difference is that we deal with revenue, so we have revenue, that is a form of equity. Expenses are also a form of equity. So any revenue that you have, that you generate, expenses that you incur, dividends. Dividends are basically the payments to stockholders, and then common stock, or any other form of stock, that is what, that's basically like the stock shares and stuff like that. You don't have to worry about the specifics of these, I'm just giving some examples. So revenue increases equity, expenses decrease equity, dividends decrease equity, and common stock increases equity. So revenue and common stock are exactly like this. This would be what their accounts look like. But expenses and dividends, it's the other way around. Their accounts look more like asset accounts, where you have a debit increase and a credit decrease. So this is kind of weird, right? It's kind of a weird way of doing things, but that's just the way it is. Now, notice how the accounts that are on the left, which is only the asset account, has the left debit. Liabilities and equity, they have the debit as a plus, right, increasing. Whereas the liability and equity have the credit as the increasing, with two exceptions. But so what the way that my accounting professor helped me understand is by saying, okay, if you're left, whatever side of the equal sign you're on is whatever side you increase. So left of the equal sign is assets, you increase on the left. Right side of the equal sign, this would be increasing the right side of the T account, the credit. So sure, that's a good way of thinking about it. But we can think of this a little more mathematically. If we take, and I'll just abbreviate, so assets minus liabilities minus equity, this is equal to 0. I just moved liabilities and equity to the other side, and we have these minuses here. These minuses essentially just mean that you are doing the opposite. What do I mean by that? So let's say that the default is this. I'm going to mark this as the default. Okay? This is how accounts are by default, right? You have debits increasing and credits decreasing. The negative here tells you to do the inverse, because that's what negatives do. They invert. And so they actually invert whether, debits and credits increase. Now then you have these exceptions of expenses and dividends. So let me kind of include all this. So we'll have assets minus liabilities, and then minus, because minus here, and then we'll add up all these. So we have revenue plus common stock, right? And then minus dividends, and then minus, I'll call expenses with X because we've already used E. So this is equity here. And so we can distribute these and this is equal to 0. We can distribute the negatives, so we have assets minus liabilities, and then minus revenue, minus common stock, plus dividends, plus expenses equals 0. And then we just move everything so that it's the same. So we have assets plus dividends plus expenses minus liabilities minus revenue minus common stock equals 0. Okay, so here, let me do it this way. So over here we have the default. This is annoying. And then over here we have the inverse. So the minus sign in front of these tells us that we're just going to do one of these, where credits increase. So you'll notice that assets, dividends, and expenses all are default, they all have this, and remember, that's what I said. So we have a double negative situation going on here because we have the negative here and the negative generated from here. So, notice how we had this minus, minus, and then minus, minus. So we have a double negative, which is a positive. And so this actually works out really well. So it makes me actually think that this is a legitimate way of thinking about this. And it's not just like a cool little neat trick. It's actually a legitimate reason for why things are like this. And so, yeah, you can basically, this is a very complicated model. I'd say the easiest way to think about this is just looking at this and knowing that the negative signs actually just mean you're taking the opposite, you're taking the inverse. So by default, just think this as your t count, and then if it has a negative, think of it this way. So hopefully that made some sense. Hopefully that cleared it up for you. So I hope that you do well in your accounting class if you're actually taking one. And if you're interested in math and watching this video and you have no idea what's going on, I'm sorry. Just wait another week and I'll have another video for you. So thank you all for watching, and I'll see you in the next one. Bye, guys.